Welcome back, everybody. We're now going to spend a bit of time talking about one of the more complicated areas. One of the more complicated areas of accounting practice, and that's the whole concept, the whole idea behind hedging. As I go through this process, and the way we've sort of put together this presentation is both to provide you with information that you can take away with you, but also to talk about some of the key aspects. So like I've done with some of the other slideshows that we've gone through in the last couple of days, I'm not going to go through all the slides, and in fact I'm going to leave out sections of the slides, but I'll explain why I'm leaving them out when I get to them. Hedging in some ways, and I'm guilty of doing this, I've actually referred to it as one of the dark sciences of accounting, because it's a subject that is actually in many ways very, very complex. And when Carl was speaking earlier, he talked about, well, one of the questions he put up on the screen was this question about the idea of the complexity of accounting, and whether when accounting is complex, it is complex because it needs to be to reflect the underlying accounting, or it is complex because it's actually written a whole bunch of new things, new instructions on top of the existing complexity that make something even more complex. As I walk through this presentation, you'll see a little bit of that coming out as we sort of do the discussion. I did want to start by giving you a little bit of a feel for where we are in the process. Now, some of you guys who were here last year would have seen very similar slides, so apologies for that. Hopefully we're building on your knowledge over a period of time. I think the first part is to say that under IAS 39, we have two components to hedge accounting. We have what we call the general hedge accounting model, and the general hedge accounting model, if you like, applies to any circumstance where you have a very clear thing that you are hedging and a very clear instrument that you're using to hedge it. There's a one-on-one relationship between the two. And then IAS 39 has a portfolio hedging section, and the portfolio hedging section tries to deal with things that are grouped, not specifically one-on-one relationships, but dealing with groups of things. IFRS 9 is taking a slightly different approach. IFRS 9 at the first instance said that yes, we need a general hedging model, but we understand that in the context of general hedging is sometimes more than simply a one-on-one relationship. There's slightly more of a portfolio nature to it. So under IFRS 9, under the general hedging model, you can hedge groups of items. You don't necessarily have to be specific items, but there still needs to be a very close relationship between the two things you're hedging. Now, IFRS 9, similar to when we talked about impairment, the IFRS 9 hedging model is now complete. The general hedging model, it's available in the standard to use effectively already. But because it hasn't yet been endorsed in the EU, and because many other countries are still trying to figure out what it means and how to adopt it, the mandatory date is probably the most important date to consider here. And the mandatory date is 1 January 2018. So when I speak about IFRS 9, and I'll talk about it a little bit later very briefly, the IFRS 9 general hedging model is something that you're probably not going to see in practice for the next 3 years. It's not going to likely hit the books for the next 3 years. And that's simply because of the fact that, as I say, it hasn't yet been endorsed, it's not yet mandatory, and because it's not endorsed and it's not yet mandatory, and also because banks are going to take time to understand how to use it, it's not likely to come in for a while. And I'll get into a few complications about this as well in a moment. IFRS 9, or the whole context that we're applying from an IFRS perspective, when we came to the portfolio hedging model that's in 39, we decided that we wanted to do a much more comprehensive view or review of how portfolio hedging works. I'm going to take a second to explain why we did that. Portfolio hedging under IAS 39 is a very mechanistic process. It's intended only to deal with one type of risk, interest rate risk, and it's written in such a way that it doesn't really reflect the way businesses manage their portfolio of risks. So the result has been that for banks applying IAS 39 portfolio hedging, what they've tended to do is come up with a very artificial process. Very artificial process where they try to meet the rules that are in IAS 39, and in so doing, very often ignore the way they are actually risk managing the process. So when the board sat down, we said, we need to consider the fact that firstly, there are other risks that are hedged under a portfolio approach. Secondly, it's not only banks that do it, we need to make it broader than banks. And thirdly, we actually want to try to reflect the way people really manage their business, not the way they actually, not the way they sort of account or create accounting for the business. Because of all those things, we realized that what we were going to be doing was quite a substantial change to practice, quite a substantial change to the way people think about business. And I'll talk about it a little bit later. So the board made the decision that we wanted to spend a little bit longer on this component of hedging. So we stripped macro hedging out of IFRS 9. It's not part of IFRS 9. It's actually going to be a separate module that we work with completely separately. Because of that, and we're going to walk into the next slide now, which is something of a nightmare of a slide. This slide talks about how the process of implementing the change from IAS 39 to IFRS 9 is going to work. Okay. Now what we said is that IAS 39 contains both general hedging and portfolio hedging. IFRS 9 only includes general hedging. In IFRS 9, you have the choice to early adopt IFRS 9 or the choice to wait until the mandatory date. But because IFRS 9 doesn't have a portfolio solution yet, you have to use IAS 39's portfolio solution even after you've adopted IFRS 9. So the first complication is when you adopt IFRS 9, assuming you adopt the full IFRS 9 exactly as you want to it, whether you do it early or whether you do it when you have to, when you adopt IFRS 9, you're still going to have a little piece of IAS 39 behind, the portfolio hedging piece of IAS 39. Now that's important for two reasons. It's important firstly because it means that you're applying some new standard and a little piece of the old standard. It's also important because the EU a number of years ago created a carve-out from one piece of IAS 39. And that carve-out relates to portfolio hedging. So in the new world, in 2008, you will have IFRS 9 with IFRS 9 general hedging. Then you will have IAS 39 with IAS 39 portfolio hedging and IAS 39 with the EU carve-out. So that's the environment that we're going into the future. And then there's one more complication, so it doesn't quite end there. Okay, the additional complication is that some people that responded to us when they heard that this was our plan said they were very nervous. They were very nervous that they thought that there might not be a workable relationship between IFRS 9 general hedging and IAS 39 portfolio hedging. So the fact that we were using some new and some old. So we've given entities the choice to keep using IAS 39 general hedging all the way through. Okay, so there's going to be a lot of complications in the process here. So let's think about the permutations. On the 1st of January 2018, some entities will choose to use IFRS 9 general hedging and IAS 39 portfolio hedging. Some entities will choose to use IAS 39 general hedging and IAS 39 portfolio hedging. That means that from the perspective of you looking at the financial results of companies, your knowledge of the way IAS 39 works is going to be really important, and your knowledge of the difference between IAS 39 and IFRS 9 is going to be really important, because you're going to see these mixtures come through. All of that aside, I have yet to speak to a bank that thinks they will keep IAS 39 general hedging. A lot of them have talked about it, a lot of them want the option, but based on their current view, they think they will move to IFRS 9. And that's because the IFRS 9 solution is a much simpler, much more intuitive solution. But banks want to keep this option open just in case. They want to keep it open just in case once they start to implement, they realize there are things in the IFRS 9 model they didn't understand. In about 3 years' time, and maybe we'll develop this slide a little bit more so it's a bit easier to read, but this slide might be something that you need to put up on your wall and remind yourself each time of the different possible permutations that might exist in this space. Right, so with that, I'm going to talk a little bit about IAS 39 hedging model, how hedging works under the current IAS 39 space, because this is what you're going to see for a while still. And the first point to ask is, what actually is hedging? What is the thing that we talk about when we talk about hedging, and what is hedge accounting? Under IAS 39, it's really important to say that hedging and hedge accounting are two very different things. Hedging is the simple act of managing risks in one financial instrument by acquiring another financial instrument with an offsetting profile. So if I'm exposed to US dollar currency risk, I have a risk in my financial statements because I have that exposure to currency risk. I have an exposure to US dollars if I'm reporting in euros. If I go out and I acquire an instrument, a swap that allows me to swap US dollars back into euros, I've acquired an instrument that allows me to offset the two different risks that are there. And so I've actually resolved this problem, this risk that I actually had. My risk, the thing my original, let's say my loan in US dollars, is a hedged item. It's the thing that I'm hedging. And I've acquired a derivative, which is the hedging instrument. The hedging instrument offsets the variability on the other side, and that allows me to offset that risk. That is the definition of hedging. Hedge accounting is slightly different. And let me stop for a moment and just take a step back. If I fair valued my risk, so if that loan in US dollars was carried at fair value, and I fair valued my hedging instrument, the derivative, the swap instrument that I purchased, I wouldn't have a problem because the two values would actually offset each other. So in the first instance, you might argue there is no need for a hedge accounting solution because fair value on one side offsets fair value on the other side. But I imagine, and I unfortunately missed Mike's session yesterday, but I imagine the word fair value came out half a dozen times. I imagine more importantly, when Mike spoke yesterday, he spoke a lot about historical cost and where we use historical cost and how we use historical cost. And what you would have realized out of that presentation is that we have a lot of historical cost that sits in financial statements, and we have in other places fair value that sits in financial statements. One clear place where that differs is that the loan that I got in US dollars is probably at historical cost because loans is something we would usually treat at amortized cost. That's the way we deal with lending arrangements. On the other side, the derivative that I bought is probably at fair value because IFRS 39, IFRS 9 both require you to carry derivatives at fair value. So what have I got? I've got a mismatch. I've got a mismatch because I'm carrying one instrument at amortized cost and another instrument at fair value. We would normally allow that mismatch to exist in IFRS because what we would say normally under IFRS is that that reflects the two different characteristics of those instruments. A derivative has different characteristics to a loan, and therefore it's acceptable that those two different measures are applied in order to record the characteristics of the two instruments. But if you have a hedging relationship, the entity has consciously entered into a situation in which it's trying to achieve an offset of the risks in the two instruments. Because it's trying to consciously trying to achieve something, trying to consciously achieve that offset. From an IFRS perspective, we say, well, we want to reflect the economic reality of that combined transaction. We're not now looking at the two parts, the amortized cost instrument and the derivative. We're looking at these two together. And so we've defined hedge accounting. But just in that example, I've already given you one example of where hedge accounting is different from hedging. Hedging, we were happy to say if it was fair, we considered a fair value relationship hedging. But from an accounting perspective, we say we don't need to hedge account for it because we've already achieved the right outcome. So here's the first place that we've actually got a distinction between the two. Hedge accounting is specifically a subset of hedging in which the accountants have tried to fix, accountants, we the IASB, are trying to fix a problem we created in the first place. The problem we created in the first place was to have different accounting bases, amortized cost and fair value. We're trying to fix that by now saying fair value applies in certain circumstances. Now, again, I didn't hear what Mike said yesterday, but what Mike almost certainly would have said is that if we simply fair valued the whole balance sheet, we would resolve this problem. We wouldn't need hedge accounting. But that goes back to some of the points we have made previously about IFRS 9. There are real reasons why the board still believes amortized cost is right in some circumstances. And because the board believes amortized cost is right in some circumstances, we accept that we've created this problem, and therefore we accept that we need to fix the problem. At the same time, if we have gone out into the world and said that amortized cost makes sense, so let's think about a simple loan, and let's think about this in the way either IAS 39 or IFRS 9 says it. We say that if I am simply capturing the cash flows of a loan, and I never intend to sell that loan, the board is arguing that in that circumstance, fair value is irrelevant because I'm never going to realize the fair value. I'm simply going to realize the cash flows. Now we've come along and we've said with a standard that actually, with a process, hedge accounting, we're going to allow you to override that initial assumption. We're going to allow you to fair value that. Because of that, when the board originally thought about IAS 39, hedging under IAS 39, we thought what we were doing was we were taking a principal, amortized cost, and overriding it with a rule. IAS 39 introduced a rule called hedging. And when you have rules, we talked about it yesterday when we were talking about impairment, when you have rules, what you're doing, you're creating an exception, you have a rule, you have to write a lot of things around that rule in order to make the rule work. Okay, and so under IAS 39, hedge accounting is really complicated. It's got some real requirements, like there must be formal designation, there must be documentation. We expect you to actually prove that the relationship between the hedged item and the hedging instrument is very, very tight. We define what kind of instruments you can use. Because we've created an exception, we want that exception to have a lot of rules to make sure that the exception is only used when we say you can use it. And that creates some anomalies, and I'll go into a few of the details now. Any questions anybody's got at this stage? All cool still? Okay, all right. Well, that was the easy part. All right. It is an exception, and because it's an exception, the IASB said that we will allow you to do it. So it's an elective decision. You decide whether or not you want to apply hedge accounting. You're not forced to do hedge accounting. But you can only do it prospectively. So you can never, under IAS 39, look backwards and say, oh, I've been hedging for the last year. You can only do it looking forward. One of the interesting tests for auditors in this space is to try to determine when the hedging relationship actually became a hedging relationship. When was that prospective process started? Now, obviously, it's when the transactions were transacted. But was there actually an intention when that transaction was transacted that it be a hedging relationship, or did people only change their minds later and decide to recategorize? Is one of the problems you have with a process like this. IASB also decided that there needs to be an effectiveness test, and decided that that effectiveness test needs to fall within very specific parameters. So if the effectiveness is less than 80%, if the relationship between the hedged item and the hedging instrument varies by within 80% and 125%, it is effective. But if it falls outside of that space, it becomes ineffective. Now, why is something like that important? Well, think of an airline. Think of an airline that's actually doing hedging. And a lot of airlines do hedging. What they hedge is their fuel costs. Now, the way that they would do that is they would say, okay, if I'm looking forward a year, I'm worried about what's going to happen with jet fuel price. So I'm going to go and buy a hedging instrument that locks in my fuel price. Because I've locked in my fuel price, I know exactly how much I'm going to buy the fuel for, so I can safely go out and sell the tickets today because I know how much it's going to cost me to fly the airplane. And if you look at the industry, there are jet fuel futures available for a year. So I'll probably have a highly effective arrangement. Jet fuel price goes up and down, my hedging instrument goes up and down. They move together, and because they move together, I achieve my objective. Awesome. When the airline wants to look out a year beyond that, so they've looked out 1 year, now they want to look out 2 years, and they want to be able to sell tickets 2 years in advance. And they want to be able to determine what that price is 2 years in advance. The problem is nobody sells jet fuel futures 2 years in advance. So what the airline has to do in that circumstance is it has to buy something different. And the thing it chooses then to buy is oil futures, because oil futures go out 5 or 10 years. The problem with oil futures is that they don't move exactly the same as the jet fuel price, because now I'm considering two different things. Jet fuel on this side, oil future on that side. And so when they move, they sometimes move a little bit out of kilter. And sometimes that little bit out of kilter is more than the 80 to 125%. So we've taken something that many people might think was a good thing that the airlines were doing. They were making sure that they had consistency 2 years into the future. They knew what their price of oil was going to be, what of jet fuel was going to be 2 years into the future. Okay, it wasn't exactly right. It had some variability, but 79% is still pretty good. 79% correlation between the two items is still pretty good. It gives them a lot better than when they had zero correlation, when they didn't know what was going to happen. We've taken that and we've made it illegal. We also ended up creating something very interesting here, which is by putting a number on something. And this we do across the board, or this we've tried to avoid across the board in IFRS. By putting a number on something, we've created a cliff effect. The cliff effect is, if I am 80% effective, I'm cool. If I'm 79.9% effective, I failed. And the failure has repercussions on my income statement. So 0.1% creates a massive problem. Yesterday when we were talking, in fact the day before when we were talking about control, we said how important it is for us not to put a number on it. You remember the example we used, and I think, Pascal, you asked me the question, was about the 10%. We said, we're not going to say 10% ownership is enough. You need to look at all the facts and circumstances. And the reason we weren't going to say 10% was enough, because we knew that the moment we said 10%, everything was going to be done at 9.99%. It's the same as control. When people thought control was 50%, they tried to make sure they only controlled 49.9%. because they thought that would be enough to get them away from it. So doing this created a problem. It created a rule, it created tram lines, and those tram lines stopped us actually having an effective standard. It meant people stopped thinking about how they were managing the risk and started thinking about how they would account for the risk they were managing. We also said the hedging instrument must be a derivative, but it can't be a written option. And we said the hedged item must be an entire item, a group of items, or a hedged risk that is reliably measurable. So you can see there are quite a lot of rules written into this process, and those rules started to drive the way people actually operated in this space. IAS 39 defines 3 types of hedge risk. The first one is fair value hedge accounting. Fair value hedge accounting is where I'm actually trying to measure the fair value of 2 items. Actual movement of 2 items on my balance sheet. Now, fair value means that those 2 items must be subject to the same risk in the same way. So let me think about something like a fixed rate loan. I agree to lend you money, and I'm going to lend you money at 1%. Okay. It's fixed. It doesn't matter what happens to market rates. Market rates go up and down. So in that circumstance, I know my cash flow. I know how much cash I'm going to receive. I'm going to receive 1% every month or 1% every year for as long as the loan goes on. So I don't have cash flow risk. But as market rates move up and down, as interest rates in markets move up and down, So what is going to happen is my fair value of my loan is going to move up and down. So that is an example of a fair value risk item. I'm concerned about the fact that my loan's value is going up and down, and therefore I take a derivative instrument that converts my fixed rate to a variable rate. By converting my fixed rate to a variable rate, I've overcome the problem of the variability of the market value. It doesn't mean that what you're trying to manage is the fair value. It means that the risk is best portrayed by looking to fair value. Why do I make that distinction? Well, normally when a bank is worried about a fixed rate of interest, it's actually not worried about the fair value because it's not thinking about the fair value of the loan. It's simply going to collect the cash. What a bank is thinking about in this circumstance is perhaps that its funding for that asset is coming from a variable rate deposit. So the bank's worry here, what the bank is thinking about, what the bank is concerned about, is that it has a fixed rate loan that is going to pay at 1% every year. It's got a variable loan a variable deposit on the other side that might pay 1% this year, but it might have to pay 2% next year and 3% the year afterwards. So its worry, its concern here is actually about the cash flows, the difference in cash flows on both sides of its balance sheet. But the way it is resolving this worry is best portrayed by the fair value of the two instruments. The fair value of the deposit stays steady, it doesn't change because it's a variable rate, so no matter where rates go, it's paying the right rate. The fair value of the asset does go up and down as rates move, so what it wants to do is it wants to lock down that fair value of the asset. It wants to make sure that the fair value of the asset also stays constant like the fair value of the liability is, that way it's actually secured. So we call this fair value hedging even if the intent of fair value hedging is not to actually achieve or not to lock down the fair value, it's to lock down something else. The important thing about fair value hedging is you've got an instrument on both sides of the balance sheet. You know there is something that you are hedging and it's on your balance sheet, and you know you have a fair value of a derivative, so you actually have the derivative on the other side of the balance sheet. And the way that we account for it under IAS 39 is we're already revaluing the derivative. We simply revalue the same component in the underlying instrument. So now my two instruments are moving together on the balance sheet, and so the movements of the two instruments offset each other. So that's fair value hedge accounting. The second part is cash flow hedge accounting. Now I want to go back to that circumstance that I had a moment ago where I said I've got a loan, and the loan's got a fixed rate, so I know exactly what my cash flows are on the loan. On the other side of the balance sheet, I've got a deposit, and the deposit is a variable rate deposit, so its cash flows are going up and down and up and down and up and down all the time. So I said one way to think about that problem is to look at the asset and to say, let me look at the fair value of the asset and try to adjust it. A different way to think about exactly the same problem is my asset is cool. I'm really happy with my asset because I know exactly how much money I'm going to receive each period from my asset into the future. What scares me in this problem is my liability. And my liability scares me because I don't know how much I'm going to pay. I don't know how much my cash flows are going to be. They might be more, they might be less, they might be more. So I can think about exactly the same problem from two different aspects. The fair value of the asset that's going up and down, or the cash flows of the deposit that are going up and down. And cash flow hedging is simply looking at the same problem from the other side. I want to make sure in this circumstance that the amount of money I'm paying away on my deposit every month stays the same. And the way I would do that is precisely the same instrument. The same derivative instrument will actually achieve the same thing here. Because now my derivative instrument that I get is also going to be a fixed floating swap. But the derivative instrument's cash flows are compensating me for the variability. So if the cash flows going out go up, I receive cash from the derivative. If the cash flows go down, I pay money into the derivative. So it's two different ways of solving the same problem. Now you might ask us then, why have we got two different solutions? Why not just stick with one solution and say make everything fair value? There are times when a fair value solution works better. There are times when a cash flow solution works better. And so what the IASB has said is in order to make sure we're addressing both of those, we will give you the choice of using one or the other, whichever one makes more sense. Okay. A simple example of when cash flow hedging might make more sense is if I decide I'm going to buy a machine in 1 year's time. I've already got the contract. I've already got the contract that says I'm going to deliver the underlying stuff. So I'm already going to manufacture the widgets or the donuts or the whatever it might be. But I still need to buy the machine, and I'm only going to buy the machine in a year's time. In that circumstance, I'm going to look at the machine. I'm going to say, well, I've got an expense that I'm probably going to spend, a firm commitment to buy that machine, but I don't yet have a liability because I haven't signed the contract to buy the machine yet. In that case, my concern, if the machine is priced in US dollars, is that the price of the machine in my euro business is going up and down all the time. And I want to make sure that I know how much I'm going to pay for that machine in euros. So I buy a contract. I buy a derivative instrument that protects me against the variability of the machine's costs. The problem is fair value accounting doesn't work in that case. Because what is the thing that I'm actually trying to grab the fair value of? There's nothing. The problem is here I'm only looking at cash flow risk. And because I'm only looking at cash flow risk, the cash flow hedging works better in this space. Now, exactly because of that, when we talked about fair value, I said we adjust both sides of the balance sheet. So we're adjusting both sides of the balance sheet and we achieve the parallel here. Cash flow hedging, sometimes there's not going to be anything on the other side of the balance sheet. So what do you adjust? Your derivatives going up and down. What do you adjust on this side of the balance sheet? And so what the IASB decided is what you must do in these circumstances is you take the movements on that asset, you take the movements on that derivative, and you put those movements into OCI. They don't go to profit and loss, they go to OCI. Okay. What does that mean if you're looking at the balance sheet of the company? It means you've got a bit of an oddity, because now you're seeing the movement on one side of the balance sheet. You're not seeing the movement on the other side of the balance sheet. And so the balance sheet goes a little bit out of kilter. So this is not the greatest solution we've got, and it's something longer term we might need to revisit. Because taking things through OCI doesn't necessarily reflect the economic reality. The one way to argue that perhaps it does reflect reality is because I'm not obliged to buy the machine. The movements on that instrument are not necessarily going to result in achieving the objective I set out to achieve. So it's a way to think about it. But that's cash flow hedging. So cash flow hedging, very often the same instruments. Sometimes you can only apply cash flow hedging, but the accounting for cash flow hedging is very different to the accounting for fair value hedging. The last one we've got is something called net investment in a foreign operation. The idea behind the net investment in a foreign operation is this is that circumstance where you're sitting in Europe, you have a euro balance sheet, but you have an investment in South Africa, so you've got an underlying rand risk. And this simply allows you to hedge the two risks that you've got. So if I'm sitting in Europe, I've got a euro company, but my underlying subsidiary is sitting in South Africa in rands. Every time the rand and the euro move against each other, I'm suddenly seeing a profit or loss pop out. Net investment in foreign operation is simply a mechanism by which you can hedge that risk so that you don't actually reflect that risk. And because under accounting we treat those changes in the underlying subsidiary in a different way, this hedging requirement simply allows you to treat the derivative you've taken, the instrument you've taken to hedge it in exactly the same way. Okay, so that's very high level what IAS 39 does. Stop and just check if there's any questions on IAS 39 hedge accounting. Gone, and we'll move straight into IFRS 9 general hedge accounting. Now what I'm going to do with IFRS 9 hedge accounting, because it's something we covered last year, and because it's a topic that is not yet relevant, I'm actually going to just touch on the basic principle, and then I'm going to move straight on from there to macro hedging. And the idea behind moving straight on to macro hedging is that macro hedging is something that is brand new. It's something that hasn't come out yet. We only had a discussion paper process. So I'll be interested to hear what people think about macro hedging and the way macro hedging works. So the starting point of IFRS 9, the starting point for the IFRS 9 general hedging model, is to forget all that nonsense about creating an artificial process. Forget all that nonsense about the fact that hedge accounting and hedging are different. Instead, IFRS 9 says, let's understand that risk management, that hedging is a risk management activity, that it is a legitimate activity, that very clever people have sat down and figured out how to do this legitimate activity, and let the accounting reflect the legitimate activity. So what does that mean in practice? If I want my accounting to reflect my hedging, it means I shouldn't have rules like 80% to 125%. If a risk manager has sat down and decided 79% is fine, then we shouldn't come along as accountants and say, no, we think it's not fine. We as accountants should say, well, then use a 79% relationship, because there's nothing wrong with using a relationship if your risk management function is doing that. Now, there are lots of people who'd say, well, is 79% really enough? Is it? That's not relevant. The point is that that is what the company is doing, and we want to report what the company is doing. Now, importantly, the way the system works, the way the designed IFRS 9 solution works, is if you are only 79% effective, then the 21% difference comes straight through your income statement. So what you're going to do is you're going to revalue the asset, you're going to revalue the liability. Because you are only 79% effective, the two values that come out of that process are going to be different. And that difference goes to the income statement. So rather than the way IAS 39 worked, in IAS 39 we said if you're between 80 and 125, so if you were at 80%, you still had a 20% difference, but you could hide the 20%. You could keep the 20% out of sight because it was effective. And when you went to 79%, you would have to show the whole 21% because now you're ineffective. IFRS 9 simply says nothing gets hidden. Revalue this side, revalue that side. The difference in the revaluation goes to profit and loss. If I am an outside party looking at your financial statements, I'm going to see a revaluation of the asset, I'm going to see a revaluation of the liability, and I'm going to see the 21% on your income statement. I'm going to see that volatility coming through. That gives me a good understanding of the business because it gives me an understanding that you had 79% protection and 21% not. And that is the concept that IFRS 9 follows in that space. It applies to other things too. It says we shouldn't, as accountants, tell risk managers what instruments they can use and what instruments they can't. Risk managers should use the instruments they believe are most appropriate for the process. So we allow them to use whatever instruments they want to use, with one exception, which I'll touch on in a second. The third thing it says is we shouldn't require risk accountants to draw up special documents, to draw up these pre-hedge documentation, because that's artificial. It's an artificial document that you're preparing. What we should say is that the accountants should use the risk documentation that's in place and should use the risk process to reflect what's happening in the underlying relationship. So effectively what we're trying to do is we're trying to hold up a mirror to risk management and say, let us show what is happening in the risk management. Now, I did say there's one exception as far as instruments are concerned, and the exception is for net written options. Now, the only reason we've made that exception for net written options is nobody has ever been able to tell us how you can use a net written option to manage risk. A net written option, in our view, and in the view of everybody we've spoken to, creates risk. It doesn't reduce risk. And so we've taken it out. Now really, because of the principles we had and everything else, we probably didn't need to do that. But we've done it simply because it kind of reinforces the principle. It helps people understand the principle better in this space. In terms of other things like how you group together the assets and liabilities, whether you hedge the assets and liabilities to an extent on a net basis, how you decide when the hedge relationship is effective and when it's not effective, all of those things, we simply said you need to apply the process of risk management, the way that you actually think about the underlying risks. Okay, that's all I'm going to say about general hedging at the moment. As I said, there are quite a lot of slides in the pack, and what the slides in the pack do is they go into a lot more detail about how you should actually think about applying risk management, what the specific issues are to discuss. If anybody's got any questions on those slides, we can either pick up the questions at the end, or what you can do is send me an email and I'm more than happy to answer it. This is one of those topics that I get quite enthusiastic about, so if you leave me alone, I can talk forever about them. And you really don't want that to happen, I promise you. But if you've got any questions, email me the questions, more than happy to answer it. And by the way, just in case, this is probably a good time to do an advert, my email address is really simple, dscott@ifrs.org. Okay, so you don't get simpler than that. Only point I would say is Scott has 2 T's, just in case you were wondering. All right, so let's just move on now quickly to, I hadn't anticipated this would be in German. No, it didn't work as well as I thought. There we go. All right, macro hedging. All right. So what I said I wanted to spend a bit more time talking about is macro hedging. And the reason I want to talk about macro hedging is twofold. Firstly, this is brand new. Macro hedging is a completely new concept. It's a completely new way of thinking about things from an IASB perspective. It changes everything that you might have thought about previously. So because it's new, because it's different, I wanted to spend a little bit of time on it. But even more importantly, macro hedging right now is in the discussion paper phase. It's a very, very early phase. We're spending a lot of time as a board speaking to as many people as possible about macro hedging to get as many views as possible. You remember yesterday when I talked about impairment and I mentioned that we had heard a view specifically expressed from the Romanian delegation last year about a problem with IFRS 9 impairment, and we were able to take that problem and use the fact that it was a problem and change the standard. Unfortunately, hedge accounting is finished. IFRS 9 hedge accounting is done. But macro hedging is still brand new. It's not done yet. So the views I hear from you, the questions you ask, the emails you send me after the session, all of those will go towards helping us understand and helping us make this into a model that actually works, that can actually be applied in practice. Okay. The first important thing is that instead of calling this macro hedging, we've changed the term that we use in the discussion paper to a different one. We've talked about dynamic risk management instead of macro hedging. The reason why we've changed that name is because when I talk about macro hedging, when I use the word macro hedging, even I, who've been banking for a long time, think of a bunch of chartered accountant geeks sitting with actuary geeks in a dark room somewhere out of sight, doing horrific things with numbers, switching around, playing with, and producing something at the end that nobody can understand. Macro hedging has very often been portrayed as a black box. This macro hedging is really the dark art of accounting. Just to give you an example, the bank that I worked for in the past, First Rand Bank, we had chartered accountants split out through the whole bank. We had, I was remembering yesterday's number, I think RBI had 57,000 employees. We had 48,000 employees working in the bank. That's a lot of numbers. And we had a lot of accountants working in the bank. We had a lot of qualified accountants, a lot of qualified actuaries. Half of the actuaries we employed worked in the macro hedging department. 1/4 of the chartered accountants we employed worked in the macro hedging department. That is so wrong. It's so wrong that you've got an activity that you need so much skill, so many people, such clever parts of the intellectual capital of a company working in this one little space. And they worked in this space because the rules, the accounting rules, are so odd that it needed this huge number of people to try and figure it out. And the problem we all had is when we think about macro hedging, that's what we think about. This dark, smoke-filled room with this huge black hole of intellectual talent being sucked into it to try and figure out how to actually make the sense of this. Changing the words to dynamic risk management moves us from something that's maybe a little bit negative into something that's hopefully a bit more positive. Dynamic risk management is something we want companies to do. When Karel was talking earlier, and he was talking about the process of actually looking at the risks of an organization, you as regulators me as used to be preparers, me in the future as shareholders, want companies to look after their risk. We want companies to manage their risk. So hopefully with a single name change, we started to get people thinking about this slightly differently. Macro hedging is kind of odd, kind of dark science. Dynamic risk management is a positive thing we want companies to do. So the starting point of this paper is dynamic risk management. It's starting with the activity of dynamic risk management. The second important thing about the discussion paper is that when we looked around the world, because of the way this dark science had been created, because of the fact that it was done in dark rooms at the back of offices, the only people we could find who were actually doing macro hedging the way we thought about it was banks. And they were only doing it for their interest rate risk. Other companies that had currency risk, other companies that had commodity risk, people who maybe had real risks in this space weren't doing this kind of activity because they either weren't allowed to or they were too embarrassed to say they were doing it because of that connotation. So in the discussion paper, we talk about banks a lot. We talk about interest rate a lot, because interest rate risk is what we've seen in the past. But the intention with the process we're getting into is a lot more than banks, and it's a lot more than interest rate risk. And for the insurance supervisors here, you would have heard a lot from insurance companies who are saying they think this could be quite an exciting solution for them now. Not just for their interest rate risk, but for the other types of risks that happen in an insurance environment. This might be a solution for them to help resolve the way they think about morbidity risk, mortality risk, and other things, and the way they try to protect themselves from those risks. So although if you happen to be enthusiastic enough to pick up the document and read it, you're going to see a lot about interest rate risk. That's not the focus. All right, so let's think about what is, in fact, dynamic risk management. What do we mean when we say dynamic risk management? And you'll remember when I talked earlier about IFRS, about general hedge models, I said the thing about a general hedge model is it's still about one thing hedging another thing. Okay, so the relationship is constant. And the way that general hedge works is that when I've got one thing and I've got another thing on that side, and another thing might be a portfolio or it might be a single thing, when one of those two things disappears, the whole relationship comes to an end, because I can't be hedging nothing. So a problem for people applying general hedge models is that it only applies for as long as the underlying thing is there. Now that's fine if I'm hedging a particular transaction, a particular loan, a particular interaction. But that's not the way banks think about interest rate risk and other companies think about the other risks they think about. If I think about a normal bank environment, I haven't got a single loan. I've got 1 million loans. RBI yesterday, 13.7 million customers. That's a lot of customers. It's a lot of loans. When I look at my risk, I'm not going to look at each loan individually. I'm looking at the 13.7 million loans. Okay. And thinking about the 13.7 million loans, the problem with those 13.7 million loans is every day, probably every minute, loans are being prepaid, loans are being paid off, new loans are being advanced. It's a constantly changing environment. So the problem when you start thinking about dynamic risk is that the underlying is changing the whole time, it's moving the whole time. And on the other side, I have to then assess my risks all the time on an ongoing basis. And I have to buy and sell risk management instruments on a continuous basis. So dynamic in this case means I'm constantly changing the thing I'm hedging, therefore I'm constantly reassessing the risk, therefore I'm constantly changing the risk management instruments I'm using. Under IAS 39, every time that bottom changed, the whole process would have to start again. Under IFRS, under the proposal in this discussion paper, because it's dynamic, you keep changing as you keep continuous process. You don't end and start and end and start. You keep going. Now, it's reflected in this particular slide as I think, and I think this was inadvertent by the staff. I don't think they meant to do it that way because they've laughed. They've looked rather embarrassed rather every time I've mentioned it. But it's represented by the symbol of eternity. Now, I'm not entirely sure anybody wants to think about it as an eternal process. but certainly it's an ongoing process. It's a process that is continuous. Every time you get to the end, you have to start again on the next cycle. Okay, so now I'm going to talk a little bit about what is a really complicated slide, and we'll come back to this slide again in a few minutes. This is simply an illustration that we use in the standard of the way we think banks actually deal with their risk in a normal environment. So what I've got is a bank here that in the blue blocks has got assets, and those assets are mortgage assets, firstly. Now, if I think about mortgage assets, there are a couple of things that happen with mortgage assets. They're long dated, and in many jurisdictions, I think France is one of them, they fixed rate. So I've got two things happening here. I've got an asset that stays on my balance sheet for a long time, and it has a fixed rate of interest. So it's got a very specific risk profile that I've got to worry about. And I talked about earlier about the risk of having an asset that is fixed as a fixed rate. So that's the first element about a mortgage that's important. The second thing is we don't ban people repaying their mortgages. If somebody wants to repay their mortgage early, we let them. And it's interesting, in different jurisdictions, you see different things happening. In many countries in Europe, it seems like people keep their house for a very long time. So they live in the same house for a long time. So their mortgage lasts for a long time. In South Africa, for reasons I haven't been able to figure out, people change houses every 5 years. So the average life of a 20-year mortgage in South Africa is only 5 years. So two things are happening with this mortgage. And the first thing, I've got a commitment to 20 years at a fixed rate of interest. The second thing that's happening, though, is that this commitment from my side is not a commitment from the other person's side. They are not keeping the loan for 20 years. They're doing different things with it. So that's the first part of my asset portfolio, the first part of the blue circle. The second part of the blue circle in this particular bank we're looking at is corporate loans. And for the purposes of the example, these are overnight corporate loans. So they repriced every day. They continually change their pricing. So now he's got a mixture of assets. He's got some assets at a fixed price, some assets overnight. Because they're overnight, you would argue that every day they almost get repaid and readvanced that day. So that's the way the asset side works. On the liability side, the bank has got something different now. It's raised money to fund the assets through two different sources. The first source is demand deposits. So deposits that effectively can be withdrawn every day. And demand deposits have an interest rate that is usually variable. It goes up and down with the market. Okay, so I've got variable rate liabilities. And I've got time deposits, fixed rate deposits. So I've got two forms of financing, one that's variable, one that's fixed. But also, again, like I talked about the prepayment on the assets, I've got within my liabilities, within my demand deposits, I've got what the industry usually refers to as core deposits. Now, I imagine most people who've been involved in banks will be very familiar with core deposits. A core deposit, and another term for a core deposit that's used but you're not in front of your customers, is lazy deposits. Lazy deposits are when a customer comes in, deposits money with the bank at a 0% interest rate or a very low interest rate with a view that they want to be able to get their money back anytime they want it, tomorrow or the next day or the next day. But in reality, they leave the money with you for 10 years or 15 years or 20 years. A lot of saving products work like that because a lot of people are not thinking about earning the best interest rate they can. They're thinking about, if I want my money, I want my money now. I don't want to have to wait for anything that's going to happen. So within demand deposits that on the face of it look like they repay immediately, look like they are variable rates, you very often find there's an element that is what we call core deposits that actually, although it's contractually immediately repayable, contractually variable rate, it actually acts like it's a time deposit with a long period underneath it, and it acts like it's fixed rate deposits. Now, one of the classic examples of this is people's current accounts. Think about your current account with the bank. Usually your current account earns no interest. Usually, hopefully, at the end of the month, there's always money left behind in it. So maybe you get your salary, and maybe you spend 80% of your salary. Okay. But there's something left behind every month. So the variable part is the 80%, the part that comes in and that gets spent every month. The fixed part is that bottom 20% that's always there. Now, the reason you're keeping it there is because you're just in case fund. It's just in case something comes up. But realistically, when banks look at this and they model it, what they see is that it actually stays in place for a long time. So within a risk management process, what a bank will do with this particular scenario, okay, is two things. The first thing it's going to do is it's going to adjust, because risk is not about contracts. Risk is about behavior. So the first thing the bank is going to do is it's going to adjust for the behavior expectation. So the core deposits it expects will behave in a particular way. So it's not going to look at the contractual, it's going to look at the behavior. The mortgages will repay early. The bank is not going to pretend the mortgages are going to be there for 20 years. It's going to figure out how long it thinks the mortgages are going to be, and it's going to use that. So the first thing is to adjust these assets and liabilities for behavior. That's the first thing that a bank would usually do. The second thing is it's going to combine them. It's not going to say I have gross asset risk and I've got gross liability risk and I need to go and do something about it. It's first going to combine the risk. So if I look at my mortgages, I might say, well, actually my mortgages are partially offset by my core deposits and my time deposits. Both have fixed rate risk, both have a long period on my balance sheet, so I can offset the two elements of risk against each other. So they're going to offset that risk. My variable rate deposits and my variable rate corporate loans have the same type of risk, so I'll offset them. And I will only look, once I've finished this process, at the net risk that's left afterwards. How much risk is left after I've offset these two things? Okay. Once I've done that, I then apply my risk management process to it. Now, I haven't, in my experience, ever seen a bank that chooses to then hedge 100% of its risk. What a lot of banks will say is, okay, we're happy to hedge 70% of our risk, or we're happy to hedge all of our risk above a minimum amount. But trying to hedge 100% of your risk has got two problems. Firstly, it is expensive. It costs a lot of money to get derivatives, so you're actually chasing that last dollar, you're spending a lot of money from a bank perspective. But secondly, maybe more importantly, every banker you speak to, probably everybody in this room, suspects they know what's going to happen with interest rates in the future and wants a little bit of that potential upside. They want to take a little bit of a risk on interest rates. They want to know that if they think interest rates are going to go up and interest rates in fact go up, they want to be able to make an extra bit of profit. So they leave some of the risk unhedged and they only hedge some of that risk. So the purpose of dynamic risk management the purpose of dynamic risk management in banks is to isolate the risk on a behavioral basis, identify what that risk is, and then decide to hedge a certain amount of the risk in process. And as I said to you at the beginning of this is very much about interest rate risks in banks because that's where we've got the most knowledge at the moment. So what is the proposal in the discussion paper? The proposal in the discussion paper says that what we need to do is we need to look at that net risk that is being hedged by the banks. So we need to look at the process that they're actually looking at. We need to look at the way that they are doing the actual dynamic risk management activities, and we need to reflect it in our financial statements. The best way to reflect this, you remember again when we were talking about one loan, we said we had one loan and we had one deposit. We said the best way to deal with one loan and one deposit is fair value. So the principle that we think would be the best way to apply this exact issue, but on a portfolio basis, is still exactly the same, fair value hedge accounting. And the way that we would do it is we would first take the instruments you're using to hedge the risk, those derivative instruments, and we will fair value those derivative instruments through the income statement. So that's one part. So let's park that for the moment. The second thing that we're going to do is we're going to take all of the assets and all of the liabilities that were in those two portfolios on either side. We're going to take all of those assets and all of those liabilities. We are going to identify the thing in them that we're trying to measure, and we're going to current value that thing within them. Now, it's really important, this is not a fair value model, it's a current value model. I'm not taking the loans and the deposits that make it up and calculating their fair value. Because that would be very tough, because that would suddenly say that, for example, on loans, I have to calculate the fair value of the credit component. And who knows what that is in many circumstances. So in this example, what I would do is I would isolate interest rate risk. That's the thing that I'm actually trying to measure. So I'd isolate the interest rate risk. I would strip it out of the assets and the liabilities. So I'd create a pot of all my interest rate risk. And then I would calculate the current value of that pot of interest rate risk. How do I calculate the current value? I look at all the expected future cash flows that relate to interest. I discount them back at whatever today's current rate is. That gives me a difference between the book value and the carrying value. I've simply calculated a current value of future cash flows using present value techniques. So that's what I've done for all of my assets and all of my liabilities. Not fair valuing them, but I am creating an up-to-date valuation. What I then do with that up-to-date valuation, that revaluation adjustment of the interest rate risk, is I take that number and I put it in my profit and loss. So I now have a movement in the revaluation of the assets and liabilities, and that movement is going to profit and loss. I take the change in value of my derivative instrument, the thing that I'm using to hedge it, and I put that in profit and loss too. And if I have any kind of science behind what I'm doing, the one fair value should offset the other fair value to an extent. To the extent that it doesn't offset, that tells the user of my financial statements that my method is not working properly, that there's something not quite right with the methodology I've used, but that in itself is useful information. It's telling the user something that they actually want to know, that they need to know. Now, why might there be a difference? There might be a difference because the actual interest rates I'm trying to hedge are not identical to the hedge instruments I can buy. In most markets, you can buy derivative instruments that refer to the benchmark interest rate. For example, LIBOR or Euribor, whatever that benchmark rate is. But very often, your loans and deposits are not exactly correlated to that same interest rate. You decide when you do the increases, and they don't increase immediately. They lead or they lag. Because of that lead-lag effect, you will find that there is ineffectiveness that comes in. We are not measuring the credit risk of the underlying portfolios, but a derivative instrument by its nature incorporates an element of credit risk. There's a counterparty determination in that value. So these are the things that will show up as part of the ineffectiveness. And we're pretty comfortable. That's what the model is intended to do. That's what the intention is with the process. Yes?
I have a question regarding the calculation of the current value of the net risk exposure. So in your example, actually, if I can sum up how I understood.
Yes.
Actually, the bank should calculate the net interest rate exposure of the assets and liabilities. Let's say like it will come up with a certain figure and calculate the current value of that net interest rate exposure.
Correct.
And the current value is calculated by applying which discount factor?
So in effect, what you'll do is and it's always useful to go back to the theoretical starting point. So on day one, your net risk is 0. Because you apply all of those discount rates and you then, all of the expected cash flows, and you discount them by the current rate on the day that you actually issued the loan. Okay, so if I issued you a loan at 5%, I'm discounting that same loan at 5%, I get 0. Because I'm going to receive cash flows of 5% and I'm discounting it at 5%. On day 10, the market rate for 5% has now moved from 5% to 6%, but my cash flows are still at 5%. So what you're using is the adjusted EIR, the adjusted rate that you would have charged the client if you had issued the loan on that new day.
It's a kind of a fair valuing the the net interest exposure?
It is a kind of fair value.
Current interest rate relevant for
absolutely. So
loans and deposits issued and obtained.
You're constantly remeasuring the expected cash flows at the current rate. It's a kind of fair value in that it's using a current rate, but as we talk even more later on about insurance, it's not really a fair value because it's not taking into account sentiment and all the other things that come into play with that. It's simply taking the rate I lent at, which is reflected in the cash flows, against the rate I would have lent at if I was lending today, which is the updated rate.
And if we can go further, this is really a very simple example now that you're giving on one loan and one deposit, but in fact, macro hedging involves open portfolios.
Absolutely.
So the interest rate that I've extended my loans is what? I mean, is it the contractual, fixed, variable? It depends. It might go further if I go detailedly enough into the portfolio. It might go back up to 20 years ago.
Absolutely.
And with the deposit, it's the same issue. So it's open portfolio on the other side as well. So
the way we understand from banks,
against the current,
it's the contractual cash flows against the current rate. And because it's the contractual cash flows, it's not about the past anymore. It's about the future. It's the cash flows you've yet to receive. Now, my understanding, firstly from the risk management process I was involved in my previous life, but also from a lot of the discussions we've had with banks, is the way the banks usually do this is they strip out the expected future cash flows. So as part of their risk management process, they strip out the future expected cash flows and they compare those back to a rate. And they even go a step further and they do a whole lot of what ifs. What if the rate changes? What will the effect be? So we're using the tools that they have at the moment, which is that stream of future cash flows, and simply requiring that they would discount those back at a rate. And then we've given them some relief in this process. We've said we understand that you don't necessarily always have the tools to determine exactly what that rate should be. So you use average rates, you can use your internal transfer rates, because those are rates that actually tell you, those are rates that you are updating and that you are tracking within an organization. So those are simplifications to help people actually do the process. But you're right, this is a big issue. And one of the reasons why we've gone with a discussion paper first is we want to make sure people can do this. And obviously one of the fears is a lot of the banks are already saying, yep, that's exactly the way we think as banks about dynamic risk. The fear is that if I'm a copper miner, is that also the way I think about my copper prices? And so it might be harder when you start thinking about this from other products. But the starting point from a bank perspective is most banks think that that is the way they think about it.
And from the supervisory point of view, it's really important within the specific industries to be there to be a common understanding and transparency how things should be done. Because if each separate bank understands the same principles differently, then we will end up in a mess.
Absolutely. Well, one of the things, and this might actually, interestingly enough, from a supervisory perspective, be an easier document to read, the discussion paper, than what a normal IFRS product is. Because what we do with a discussion paper is we discuss the issues. We don't try to get that commonality at this stage. We try and from a very high level to say, here's the problem, here's how we would think about solving it. What do you think about that? Do you think we're sort of heading in the right direction? Do you think this makes sense? Do you think the simplifications like using an internal transfer rate applied to streams of cash flows would actually work? Or don't you think it'll work? And if not, why? But it's a high-level document, so it makes it a lot easier to read because it's not saying that's how you must do the accounting. It's saying this is how you must think about the principle. Okay, any other questions while we're here? All right. So I've said we set off net profit and loss will show me the difference between, so it will show me the ineffectiveness. Why do we think this will improve? We think it gives information, not about an artificial accounting process, but about the way a company is actually managing the risks it has on its balance sheet, the way it approaches those risks. It reduces operational complexity such as tracking. I don't have to worry about exactly to your question, I don't have to worry about what the rate was when I started. I don't have to worry about the rate of each individual instrument. I don't have to worry about whether the instrument that I originally hedged is still the instrument that is there, because I'm simply looking at these global portfolios and the cash flow streams of these global portfolios. It also captures the reality of where we are in the space, the way companies actually think about this type of risk. And finally, it considers the behavioral factors, the things like the changes in mortgages, the way mortgages are actually, the reality that mortgages are not 20-year products, but 5-year products or 10-year products, the fact that core deposits are not overnight deposits, but they're in fact longer-term products. Now we get on to the tricky question. How do you apply the scope to the actual process? So remember what we said up till now is that if I'm within the scope, I'm going to have to take all of the cash flows of my underlying portfolios. I'm going to have to remeasure all of those cash flows. So once I'm in the scope, I've got to do this for everything that is within the scope. Deciding what the scope is becomes a very difficult exercise. So we considered two approaches, and one of the approaches is broken up into two. And I apologize, the next two slides aren't in your packs. But it's simply taking that one we talked earlier when we said, how do banks manage their risk? The first scope requirement is to say, well, once you hit that button, once you say you're in the space, everything is in. So everything you do is in. The logic behind this process is that's usually the way banks think about interest rate risk. I don't say I'm going to manage the interest rate risk on my mortgages, but I'm not going to manage it on my fixed deposits. Or I'm going to manage it on my corporate loans, but I'm not going to manage it on something else. Realistically, if you're thinking about interest rate risk, you're thinking about the whole universe of your interest rate risk. So this approach would suggest that you take everything and you remeasure everything. Once you're in, you're in. Now, what is the problem with that? It creates one really nasty side effect. Remember what I said about the fact that banks very often choose to hedge some, but not all of their risk. Okay, so what's going to happen now if we apply this to everything? For the some risk that they're managing, I'm going to see movements in my underlying assets, and I'm going to see movements in my derivative, and the two are going to set each other off. But for the assets that they are not managing, the ones that they've decided to leave open because they've decided that they actually want to have that risk on their income statement, just the one side's going to move and the other side's not. And what's going to happen is suddenly we're introducing new volatility. We're introducing a volatility on the unmitigated portion of the portfolio, the portion on which I'm not trying to offset risk. Now, some would argue that that's a good thing, because the bank has consciously decided to take that risk. So let's measure that risk. And that's fine. The problem is that if a bank decided to do nothing, it wouldn't have any of this problem. And even though it was consciously taking the risk, you don't see it at all because you measure those instruments at amortized cost. For another bank that's doing what you might argue is the good thing, and let's say mitigating 80% of its risk, I'm seeing the volatility of the 20%. So I lose comparability potentially if I do this. Unless I say to all banks, you have to apply this even if you are not hedging. And so that becomes a part of the problem. We have to make it in that circumstance mandatory for everybody. Does that produce an answer that makes sense? So the second scope alternative is to say, okay, well, instead of focusing on everything, let's only focus on those exposures where you have chosen to mitigate the risk. And there are two ways we can do this. We can say, all right, only pick out those portfolios where you really are managing the risk, and ignore those portfolios where there's not really any risk management happening. Now, one classic example of this might be if I have a subsidiary in another country and I'm not actually managing their risk. The problem with this type of approach is immediately it starts to say, well, hang on a second, because I'm actually managing my risk in totality. When people start applying this, they're going to artificially select some portfolios, and they're going to pretend that it's those portfolios they're managing, and they're going to pretend that other portfolios they're not. So that feels like heck of an artificial. So a different way of doing it is a proportional approach. So instead of now saying I pick portfolios, instead what I do is I look to my risk management policy and say, all right, my risk management policy is to hedge 80% of my portfolio. So what I do is I take 80% of every sub-portfolio all through the organization, and I remeasure 80% and I leave 20% unmeasured. I don't remeasure that 20%. That gets me a lot closer. The problem with that is that you won't find a bank out there that has a policy that is that specific. They manage, if they think interest rates are going down, they might manage 60%. But if they think interest rates are going up, they might measure 90%. In other words, they actually change due to circumstances. And trying to change those ratios on a continuous basis is very difficult. So the way that a bank might apply this is using a low watermark. They say they manage anywhere between 70 and 80%. So they'll pick the low watermark, 70%, and live with the volatility on that extra 10%. But this does create a little bit of an additional complication that people have to think about. Okay, so that's where we are with the macro hedging project. It's ambitious. Thank you very much. Thanks a lot. It is an ambitious project. Are there any other questions anybody wants to ask me about macro hedging?